Good evening. This is Rahul Magan here as a Group Chief Executive Officer, Treasury Consulting. I wish to pass my sincere thanks and regards to taxmen. Although I did many times, but I really wish to do it again. Ladies and gentlemen, my father is no more, but my father told me that if you are finding something good, then you are supposed to appreciate. And I think that taxman deserves appreciation. I bought this book of taxmen, which is Indian Accounting Standards, around 3 to 4 months ago. And I'm telling you one thing, that this is a fantastic book. I was looking for a very good book about IND-AS, but the way they explained IND-AS, especially when I was looking AS 107, 108, 109, it is really fantastic. It is really fantastic. And I request taxman to have my, acknowledgement of that, please. Ladies and gentlemen, credit risk is one of the most significant risks a company is facing nowadays. Now, when I say a company, I mean a bank also. Please take a note that even a bank is facing a significant credit risk. There is a term in the Basel III which is rightfully titled as significant increase in credit risk, which is shortly known as SICR. And ladies and gentlemen, there are specific quantitative models which are defined as far as the significant increase in credit risk is concerned. Let me tell you one thing. But this is highly unfortunate that when it comes to Basel III, the pertinent text is bare minimum. This is highly unfortunate. But this is beyond my jurisdiction. I can't handle them. This book which I bought with a clear intent of AS 107, AS 108 and AS 109, of course, many other AS to consider, but you know that I am coming from financial market background, henceforth 107, 108 and 109. Read with US GAAP, read with US GAAP 157, 133, 142, 142R, IFRS 3, 7, 9 and 13 are very important for me. Very, very important for me. In this book, one of the beautiful things is the language. The language which is used is really very, very interesting language, and I really appreciate that. Barely you find such kind of classic language which is used. Let me visit page number 1031. I repeat, page number 1031, which pertains to AS 107. On my right hand side, there is a computer, and I have opened the AS 107 detailed PDF, which is over around 53 pages on the internet, because this book is linking this with that AS 107, which is good. Now, what this book is talking that paragraph number 35FB requires the disclosure of information how an entity has defined default for different financial instruments and the reasons for selecting those definitions. Very, very, very right point. I went to my right hand side. You can see that my posture is changing. I went to 35FB. 1 minute, and here is the answer. 35FB, which is referring, now the law is saying that an entity definition of default, including the reasons for selecting those definitions, which means that if an entity is giving a disclosure of information, they need to give the reasons also. That's very important, and this is what Act is saying. That's very important point. Now, this book is saying, in accordance with paragraph 5.5.9 of IND-AS 109, the determination of whether lifetime expected credit losses, shortly known as ECL, should be recognized is based on the increase in the risk of a default occurring since initial recognition. I completely agree. And I title this as SICR, which means significant increase in credit risk. Now, I coming to page number 1033. Here it is saying paragraph 35M requires the disclosure of information about the entity credit risk exposure and significant concentration of credit risk at a reporting date. Kindly note that the book is using reporting date, which might be a month end, which might be a quarter end, or which might be an year end. Okay, let's move 35M as per the book. Now, wait a minute. Okay. Now that 35M is rightly pointed. It is saying that to enable users of the financial statement, to enable users, analyst, government, research analyst, and probably the international investors, Indian investors, and XYZ. To enable users of the financial statement to assess an entity credit exposure, and understand its significant credit risk concentration, which I technically titled this as SICR, which is known as significant increase in credit risk. An entity shall disclose by credit risk rating grades. Now, here there's a small interpretation issue, but anyways, the gross carrying amount of financial asset and exposure to a credit risk on loan commitment and financial guarantee contracts. That's a beauty. On loan commitment and financial guarantee contracts. Remember, ladies and gentlemen, financial guarantee contracts may or might not be contingent in nature. I repeat, may or might not be contingent in nature in the sense that they may come as an off-balance sheet, they may come as an on-balance sheet. This completely determine how the relevant entity, including a bank, defined that. Please take a note of that. This information shall be provided separately for the financial instruments, which means the derivatives and all. And there are three sections, A, B, C, for which the loss allowance is measured at an amount equal to 12 months, for which the loss allowance is measured at the amount equal to lifetime, which is known as ECL, credit impairment and all, and that are purchased or originated credit impaired financial asset. Originated credit impaired financial asset. Originated credit impaired financial asset is a very, very tricky term. I'm not discussing in this video because I might be needing lots of time to discuss this. But in short, originated impaired financial assets are those which are available at a throwaway price because of the credit rating issues pertaining to that asset, simplistically speaking. Paragraph number 35M requires the disclosure of the entity about the credit risk exposure and significant concentration of the credit risk at the reporting date. I completely agree. A concentration of the credit risk exists when a number of counterparties are located in a geographical region or engaged in a similar activities and have similar economic characteristics that would cause the ability to meet contractual obligation to the similar affected by the changes in the economic or other condition. Actually, rather than using so long, you can simplistically say it is thematic in nature. So which means that if any bank or any entity or non-banking financial corporation, they lend huge money to real estate sector, like what is happening in China, and God forbid that Chinese sector, that real estate sector is now collapsing. So it is a hit to the banks, The number of credit risk rating grades used to disclose the number in accordance with the paragraph 13M. Actually, when it comes to credit grades, that is really a very interesting and however a debatable point. interesting in the sense like the credit grades which you are talking, that depends upon the credit rating, and credit rating is done by a relevant party who is known as credit rating agency. And credit rating agency always saying that they are not getting the data, or even if they are getting the data, that data is not thorough in nature. So this is really an issue. If the past due information is the only borrower specific information available, then an entity use the past due information to assess whether credit risk has increased significantly since recognition in accordance. When an entity has measured expected credit losses, which is shortly known as ECL, on a collective basis. Now, collective basis means pool basis. How this is technically correct, that is something we cannot discuss, but collective basis means that you are creating a pool. That pool is something substantial issue, because pool may be right, pool might not be right. The entity may not be able to allocate the gross carrying amount of the individual financial asset or the exposure to the credit risk on the loan commitment and the financial guarantee contracts to the credit risk rating grades for the lifetime. That I completely agree. That's why I clearly said that when it comes to pool, you should not be doing this. But, ladies and gentlemen, we need to understand one thing very clearly, that credit risk is something which is a very big risk which we are holding. There is no doubt about that. Please be note that AS 107 is covering the credit risk. But very important thing about the credit risk is the ECL, which is called expected credit losses. Ladies and gentlemen, we also need to understand that United States is one level ahead. When it comes to ECL, they have CECL, which is called current expected credit losses. So they have their own model of ECL. Apart from that, the top banks in the world, they have their own proprietary model about the credit risk. That's also a beauty of the game. But yes, one thing which I completely agree and one thing which I completely appreciate as far as this book is concerned is that the disclosure of information of the credit risk should be there. Now, whether that disclosure is happening or whether that disclosure is not happening, that is subject to a substantial issue. Let me speak something for you. The very important thing is that when it comes to you have two kind of disclosures about the credit risk. Number one is definitely the quantitative disclosure. Number two is the qualitative disclosure. Now, let me first answer the quantitative disclosures. When it comes to quantitative disclosure, you should have a model. And that model should measure the very important thing, which is called the market risk. That model should also measure, which is called liquidity risk and interest rate risk. Let it be very clear. When I speak about the US banks, then you are having a very beautiful concept called interest rate risk in banking books. Interest rate risk in banking books. This model is so sophisticated that it even covers a basis point impact in the books of the bank. This model is so sophisticated, but that's highly unfortunate that many countries of the globe not decided to adopt this model. When it comes to interest rate risk in the banking book, people even do not aware this about. Henceforth, when it comes to the quantitative, please take a note, quantitative part, then one thing which we really need to understand is how exactly it works. Now, unfortunately, there is no specific model which we are having in the law that you have to have. Example, even in the hedge accounting, it's up to you. You are going quantitative or you are going qualitative. Even if you are going quantitative, it's up to you. It's highly unfortunate that even in 2023, when it comes to mark-to-market valuation methodology, there are many gray areas which we are having, very many areas which are subject to interpretation issue. Similarly, when it comes to the quantitative disclosure about the credit risk, there are still many gray areas. Now, one of the gray areas which I wish to highlight in a very short is the thematic piece. Example, it is the bank which will determine how much percentage of the exposure they can lend to a relevant industry. But why a bank should determine this? That's more important. It is the regulator which should be determining this. And that ratio, assuming 20% for a minute, simplistically, that ratio should be updated in nature because it keeps changing. It keeps changing. It keeps changing. Another important thing is that the risk parameter of one industry, say X, this risk parameter is completely different for another industry. Henceforth, when it comes to the quantitative credit disclosure, the more onus is on the entity than on the regulator. And when this entity is a bank, the onus is on the higher side. You understand that? This is Rahul Magan from Treasury Consulting. You have my number 9899242978.